like you're hearing this discussion, because we haven't really had this discussion since the Fed talked in this depth. And what we really we talk about all these specific things, but we kind of come away from it and then we're saying, okay, so what, so what action does this bring, if anything? What changes should it cause? And so when we think about this, then we kind of start to think of just time horizon. So when we step away from all these things could happen and no one knowing what will happen, this is where we really step back and say, so what is my time horizon? Do clients need this money next year? Do they need it in 10 years? And that starts to shape changes you would make or how you would want to be invested. And I think that's just one of the important things. This, for us, investing for our clients is not a hobby. This is something we take really seriously because we want your money to be there when you need it. And that's what we're planning for. And so that's where, as we think about this, that time horizon becomes so important. And that's why it's so specific to each client. We're going to invest you for how you need, not for how everyone else needs. So I think even, any thoughts on just kind of that time horizon, just keeping that into perspective too?
Yeah. I mean, certainly. And we talk about this with clients all the time. There's a lot of different factors that go into that. Any client of ours that has gotten a plan from us, we have this whole matrix of, your age, your income levels, your job stability, your net worth, time horizon. Yeah. Really, there's a lot of factors that go into saying, like you, Michelle, you should be invested 80% stocks, 20% bonds. Or, you XYZ client going into retirement should be 60-40. The time horizon really is the biggest swing factor, though. And it's logical because, let's say, for example, you want to go buy a house next year and you're like, I'm going to put $100,000 down. It would be very unwise to throw that in the stock market because maybe it works and, stocks go up 20% and it's like, oh, now I got 120 grand that I can put down. But we could go through 2022 again where stocks are down 20% and it's like, oh, now I don't have enough for a down payment. And, so like, you really just think like short time horizon, it's like invest conservatively. Long time horizon, you can be a little bit more aggressive. But yeah, that is such a huge thing. And even for retired people, statistics say, I don't have the number at the top of my head, but basically if you make it to like age 60, your chances of making it to age 85 or 90 are pretty good. And so even when you get into retirement, it's like you still might have 10, 15, 20 years. That's a very long time horizon to be able to kind of ride all the market's ups and downs.
Exactly. And I think one of the nice things is when you are invested in a diversified portfolio for your time horizon, then you won't see these big, large swings that you're uncomfortable with because you'll be invested like you should be. So, you're not going to see big movements if you shouldn't be seeing them because how you're invested will reflect that. So I think it's just important. We're really kind of, I guess, emphasizing how all of these pieces fit together. But it's helpful, though, just to think about all the in-depth things that are happening today, kind of what we think ahead, and then tying it together.
Yeah. And the key to winning in investing is really just being consistent and having the framework in place. So, I'll harp on it again, a well-diversified portfolio with kind of a structure around it to rebalance it regularly or whenever it needs to. So, we have that, a well-diversified many asset class portfolio that we invest in any given year. Some stuff works, some stuff doesn't. The old joke in the advisor world is when you have a diversified portfolio, you're always having to apologize for something. And that is certainly the case because well-diversified portfolio where everything goes up or everything goes down at the same time is not a diversified portfolio. But, also having the structure in place of, okay, we'll let, this is our target model. So, you XYZ client, 60% stocks, 40% bonds, many asset classes underneath each of those. We have a model and then, we watch things every single day. It's like, okay, our high yield bonds, have they done so well that they're now drifting out of tolerance? So we have established tolerance ranges where things can move kind of up and down, but once they hit that tolerance range, we're going in there and we're basically adjusting the portfolio to make sure it's consistent. And I mean, that consistency, I cannot overemphasize how important that is in any financial plan, because, again, all the way at the beginning, we talked about if you have a great plan, but you don't have a very good or consistent or thoughtful way of actually executing that plan through your investments, then the plan really, there's not a lot of value there, because, something goes wrong and all of a sudden you're having to reboot the plan. So the last thing we want to do as advisors, and every time we go through a plan or plan update, I mean, we're always talking about this. I mean, we want to make sure that whenever we present to a client and say, okay, we're pretty sure you're in good shape for retirement, we don't ever want to have to go back and say, oh, shucks, we screwed this up. What did we say 2 years ago? Or what did we say a year ago? What were the goals? And, update it. And because we really want to have a consistent experience for clients where they know what is going on and they can reasonably feel confident that, yes, we can retire and do this, or yes, we can buy this house, and not have to worry too much about getting a phone call and saying, oh, we invested you in, a bunch of crypto stuff that went to zero. Sorry about that. Do you want to update your retirement plan to reduce spending? I mean, it's so that, that is really important.
Yeah, no, that's helpful. I think we hope for the bull market. We're optimists. We're going to hope for that. We want that to happen.